Are you wondering which Singapore bank is the better bet for your money right now? If you've checked the latest headlines, you might feel like you're stuck in a tug of war. DBS and OCBC are both giants, both posting strong numbers, but the story beneath the surface is far more interesting. Here's the twist. While everyone's focused on shrinking interest margins, the real action is happening elsewhere. Dividends are heating up, capital returns are making waves, and fee income is quietly becoming the hero of the quarter. But here's the catch. Most investors miss the signals hidden in all the noise. They chase the highest yield or the flashiest buyback, but often overlook the subtle shifts that can make or break their returns. Today, I'll break down exactly what's driving DBS and OCBC in the first quarter of 2025, what the numbers really mean, and most importantly, how you can use these insights to make smarter moves with your portfolio. If you want to go even deeper and get exclusive investing insights delivered to you every single day, here's your chance. For just $1 a month, you can become a premium member and unlock a wealth of additional content. Think daily market analysis, early insights into promising trends, and deeper dives into specific investment strategies. It's like having a daily dose of financial fuel to supercharge your wealth building journey. I'll share more on how to join after the intro. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Let's dive in. This quarter, both DBS and OCBC are feeling the squeeze from lower interest rates. Picture Singapore's weather mostly sunny, but you still want to keep an umbrella handy. Margins are under pressure, but both banks are finding smart ways to keep returns attractive for investors. Let's start with the basics. Net interest margin is like the profit a bank makes from lending out money at higher rates than what they pay depositors. When interest rates fall, this margin gets squeezed. In the first quarter of 2025, DBS posted a net interest margin of 2.09%, while OCBC came in higher at 2.56%. So OCBC edges ahead here. But should you always chase the highest margin? Not necessarily. Lower margins can be offset by other income streams, which brings us to our next point. Fee income is the unsung hero this quarter. Think of it as the bank's side hustle wealth management, insurance, and investment products. This is where both banks are flexing their muscles. DBS saw fee income rise by 7.7%, while OCBC saw an even bigger jump of 11.3%. OCBC pulls slightly ahead, thanks to more clients turning to their wealth and insurance products. Imagine fee income as the engine that keeps running even when the main road interest income is blocked. It's a sign both banks are adapting to a tougher environment. If interest rates keep falling, which bank would you bet on, the one with the higher margin or the one growing its fee income faster? Both banks are spending more, mainly on staff and technology. But are they spending wisely? This is where the cost-to-income ratio comes in. For DBS, it's 37%, while OCBC's is around 41%. Lower is better here, and DBS is more efficient. Think of this as how much it costs to earn every dollar of income. If you ran a shop, you'd want to keep your costs down while boosting sales. DBS seems to have the edge in efficiency, but OCBC isn't far behind. Non-performing loans are like the weeds in a garden. Too many, and your returns suffer. Both banks are keeping things tidy. DBS has a non-performing loan ratio of 1.1%, while OCBC's is even lower at 0.9%. Both numbers are low, which is great. But with global trade tensions and a slower economy, there's a chance this could change. Are these low levels sustainable if the global economy stumbles? Now let's talk about what matters to many investors getting paid. Both banks are stepping up. DBS is paying a quarterly dividend of 60 cents per share with an expected full-year payout of $2.40 per share. That's a yield of 5.7%. They're also running an aggressive $3 billion share buyback program. OCBC, on the other hand, pays dividends semi-annually with a special payout earlier this year. Their expected full-year dividend is 82 cents per share, yielding 5.1%, and they have a buyback program of up to $2.5 billion, though it's less aggressive than DBS. If you love dividends, both banks are attractive. DBS is going all in with buybacks, which can boost share prices over time. OCBC is more conservative, but still rewarding shareholders. Are you looking for immediate income, or do you want the potential for share price growth through aggressive buybacks? Let's check the scoreboard. DBS shares are trading at $42.45, having recently corrected from their highs, but now stabilizing. Analyst targets for the year range from $39 to $43. OCBC shares are at $16.15, consolidating after hitting all-time highs earlier this year. Analyst targets range from $14.40 to $19.50. DBS has pulled back a bit, which could mean an opportunity if you believe in its long-term story. OCBC is holding steady after a strong run. Is it better to buy after a correction or during consolidation? What are the pros saying? For DBS, most analysts suggest holding. The strong capital return plan is a plus, but slower profit growth and global tax changes could be headwinds. OCBC is seen as a value play with a buy tilt, thanks to its lower valuation and steady dividends. They're less aggressive with buybacks, but offer stability. If you're a cautious investor, OCBC might feel safer. If you like a bit more risk for higher potential reward, DBS's aggressive buybacks could appeal. Singapore's economic growth forecast for 2025 has been trimmed to between 0 and 2%. Global demand is soft and trade uncertainty is high. But here's the silver lining. Singapore banks are well capitalized and considered safe havens. They offer attractive dividends and strong buffers, even in choppy waters. Think of Singapore's banks as sturdy ships in a stormy sea. They might sway, but they're unlikely to sink. Let's break it down into simple action steps. Both banks offer yields above 5%, so if you're after income, they're top picks. If rates drop further, profits could come under more pressure, so keep an eye on global trends. DBS offers growth and aggressive buybacks. OCBC gives you value and steady dividends. A mix could give you both stability and upside. Trade tensions and slower growth could impact asset quality later this year, so monitor global risks. DBS is stabilizing after a correction, while OCBC is consolidating. Watch for signals before jumping in. Dividend investors can lock in yields while prices are soft and reinvest those dividends to compound gains. Growth seekers should wait for technical signals before entering and set stop losses to manage risk. Long-term holders should stay the course, but keep reviewing allocations as the macro picture shifts. With both banks offering something different, which fits your investing style, steady value or aggressive return. So here's the bottom line. Both DBS and OCBC are strong, but each brings a different flavor to the table. DBS is going big on capital returns and buybacks, while OCBC offers value and stability. If you're looking for income, both are top-tier picks. If you want growth, DBS's aggressive buybacks could give you that extra boost. But remember, keep an eye on interest margins, global risks, and always review your entry points. Stay diversified, keep your eyes on the data, and always invest with a plan. If you found this video helpful, let me know in the comments. Do you prefer DBS or OCBC, and why? Don't forget to like, subscribe, and share this video with your fellow investors. And if you want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information to help you on your financial journey. If you want more on Singapore's top banks, check out my previous video on how to build a dividend portfolio with Singapore's blue chip stocks. That's it for this edition of the Investing Iguana. Until next time, keep investing smart.